In today's fast-paced world, many of us are seeking ways to create additional income streams to de-risk our financial position, or even better, to stop having to trade our time for money. This is where passive income and cash flow assets come into play. With a bit of effort and the right strategy, you can build a portfolio of assets that will generate you recurring income over time, giving you the financial freedom to pursue your passions and live life on your terms. I'm asking just two things of you today. One, do not fall into the trap of trying to make a quick buck or thinking wealth generation is quick and easy. Two, be open-minded and willing to learn. What would it mean to you and your family if you can generate income outside of your 9 to 5? One of the biggest mistakes you can ever make when it comes to wealth and money is mentally ruling yourself out of ever reaching these financial highs. There are usually deep-seated psychological elements to these beliefs, which can also be described as having a fixed mindset. It may be that when you were a child, you heard parents arguing about money or talking about not having money to do various things. Imagine being a child who is told, "We can't afford that," or "Do you think we're made of money?" Or even worse, "People like us don't get to do things like that." It's not to say these statements are wrong, except maybe the last one. As children grow up, it is our duty as parents or grandparents to teach the importance of money management and financial control and balance, the same as any other aspect of life. But as with all success stories in life, you need to mix balance and control with a growth mindset and think, I can do this, because you can do this. With these behaviours and mental preparation comes great opportunity to outperform your own targets or beliefs, way beyond your wildest dreams of what is possible. To quote a famous Warren Buffett saying, "It is not necessary to do extraordinary things to get extraordinary results." In order to create additional income streams or passive income, despite what anyone may tell you, you must put in work up front. Some require way more work than others. Unless you receive a windfall, will require you to have some kind of cash up front to be able to invest. However, the magic happens when you do start to invest. We're going to start with the simplest and most passive cash flow assets first. These can be standard bank savings accounts or high yield savings accounts, and typically they are with high street banks, but you can also get online services as well. You'll get higher returns with new customer offers or on longer term savings plans such as 3-year or 5-year options. The benefit of saving with a bank is that the risk to your savings is extremely low. For all money saved into a bank, your money is protected up to the value of $85,000 per person per financial institution. In today's market, now that we have high interest rates, savings of between 3 to 6% are achievable. This means that if you save the maximum amount that is allowed of $85,000, you will get interest returns in year 1 of $5,100. That's pretty decent considering it's a very low risk option with great returns in today's market. In addition to being low risk and getting good returns in today's market, it's really easy to set up a savings account, and this can be done within 5 to 10 minutes. Bond investments are basically debt securities issued by governments, corporations and other organisations. In other words, when you buy a bond, you are lending money to the issuer of the bond in exchange for periodic interest payments and the return of the original capital investment at the end of the agreed term. Bonds are considered to be low-risk options for investors, and they provide completely passive income in the form of interest payments on the principal amount of the loan. There are a number of pros and cons that you need to be aware of when investing in bonds, however. Bonds are typically considered to be less risky than securities or stocks, as they provide a fixed stream of income in the form of interest, as well as the return of the principal amount within an agreed time limit. Payments received are at fixed terms and regular intervals, which is why in a typical balanced pension or 401k portfolio, the advice is generally to increase bonds and decrease stocks as a percentage of your investment as you near retirement. Having bonds in a portfolio offers you some diversification and reduces the volatility of the overall portfolio. Bond prices and yields are inversely related, so as interest rates rise, bond prices will fall, meaning that an investor's bond holdings can be negatively impacted by changes in interest rate. If the issuer of the bond defaults on the interest or principal amount, it can result in a loss. The agreed return on the bonds may not keep pace with inflation, which over time will erode the value of your investment. Unlike stocks, bonds do not offer any potential for the principal amount to increase, even if the company or corporation you're investing in sees huge growth in the period of the bond. A dividend stock is a stock that you purchase, such as Johnson & Johnson or Coca-Cola. When these companies make a profit, they pay back some of their profits to investors in the form of a dividend payment. These dividends are typically paid on a quarterly basis and can range from between 1 to 8% or maybe even higher in some scenarios. This means that if you hold a stock of a company that pays a dividend and reinvest those dividends every year, even if the stock price of that company does not appreciate, your investment in that company will grow over time, as those dividends will be purchasing additional stocks of that company. Dividend stocks are a great way to receive consistent income throughout the year, and when you reinvest those dividends, you can also take advantage of compound interest, which can really turbo boost your financial investments. One thing to mention with dividend stocks is that if they have a bad financial year, they can cut their dividend. It is not guaranteed, so you'll need to make sure that you're not putting all your eggs in one basket and that you stay diversified. One way to do this is through equity index funds. I have used various online services such as Free Trade or Trading 212 to purchase stocks, ETFs or index funds. I'll leave links in the description below for those who are interested. Property investment holds a raft of opportunities for those willing to put in time and effort to learn about it. There are so many opportunities within property investment, from single buy-to-lets or property refurbishments, but many others out there as well. Property investment is my favourite investment vehicle personally for the numerous benefits they provide. But despite what anyone tells you, as I said earlier, it is definitely not passive. The cash flow and assets we've been talking about require capital and typically a good deal of it before you start seeing meaningful returns. With property, however, you can get great returns from smaller chunks of cash. For example, the first investment property I purchased cost me $24,000 with all costs factored: deposit, stamp duty, solicitors' fees, limited company incorporation, etc. Did the property cost me that little? No, of course not. It cost me $75,000. This is one of the benefits of being a property investor. You can leverage debt in the form of a mortgage, make a consistent fixed payment on that mortgage, but then bring in a full return on the entire price of the property. Although you can use leverage in the stock market, it's extremely risky and you can lose a lot of money. So to give you an example, my £24,000 property investment on my first property has been returning me around $5,400 after fees every single year. This gives me a 22% return on investment, meaning that after 5 years or so, my investment, assuming no additional costs, will be returned back to me. In addition to this, property prices have, and I believe will continue to grow over time. The reason for this is simple. We are an expanding population and supply is simply lower than demand. Now, being that this video has been shot in 2023 and interest rates have risen to their highest level since 2008, it would be lax of me not to mention the pitfalls of property investment. I have made another video which I'll pin in the comments, which shows you the steps you need to take before even purchasing a property, but right way through all the ins and outs of property investment as a beginner, should you be interested. Interest rates have risen significantly, so you also need to ensure that you have enough of a profit margin in the rental to give you the returns you are looking for. In addition to the interest rates rising, property prices are falling and landlord legislations are tightening. I have seen some panic and annoyance amongst investors who are now leaving the sector and selling up. Now that house prices are in decline, everyone is waiting. But if you're in this for the long haul, this represents a great buying opportunity. Everyone has been saying that property prices have gone up too sharply and for too long, and they must come down. Well, now is that time when they're starting to drop. Maybe you've been interested in buying property for a few years, but you haven't done because prices have been too high. Well, now is that time. To quote another Warren Buffett phrase, the stock market is the only place where you get a sale and everyone runs out of the shop. This is similar with property. Prices are down, interest rates are up, costs are higher, legislation is higher, landlords are selling. Is this negative? Well, it is if you don't manage the risk or learn how to handle them, but there are also a lot of pros at the moment as well. Well, as we mentioned, rents are up, but there are also a lot of management companies out there available to support in managing your property for you and offering you advice around management of your property. So yes, there are pitfalls, but there are also additional rewards. Who knows, in 5 to 10 years we could look back at this video and I could be completely wrong. House prices have crashed and burned or stagnated and I'll look silly. It has happened with the Chinese housing market, for example, but the reason I believe we're not in the same position as them is simply because UK house building is not meeting the demands of new buyers. So we're at the far end of the scale now that I mentioned earlier in terms of how passive the investment strategies that we've covered have been, and property is definitely not passive. As I mentioned at the beginning of this video, there are no shortcuts to financial freedom or creating additional income streams. They always require a great deal of work up front before you can start to reap the rewards. Which brings us on to our last topic for today's video, which is starting a business, or if you're lucky and have a lot of capital, investing in a business can be lucrative. When you think of business and business owners such as Jeff Bezos or Bill Gates, although he's retired now, what do you think made them so successful? They had a purpose. They saw a gap in the market and they filled that gap pretty spectacularly as well. They needed a great deal of drive and determination. Starting a business from your garage isn't particularly flashy, but Jeff Bezos turned that into Amazon. The gap he filled was the ability to have an online store that will sell pretty much anything you could ever need without the need to go to multiple shops or stores online to purchase what you require. Once the upfront work has been done and you've got a business up and running, the rewards can be incredible, depending on how big of a problem your business resolves and how much people are willing to pay for the resolution of that problem. So in summary, don't think of these investment ideas that we covered today in isolation. The more varied your approach and the more willing you are to take a risk, fail quickly, learn, adapt and improve, the higher your chance of success. Just don't let that little voice in your head tell you that you can't or you shouldn't. Or what if you fail? Absorb as much information as you can. If you get a chance, validate that information with someone who might know more than you. Ask questions and then just go for it. If you have found this video content useful, please like and subscribe. I'd really appreciate it. It helps the channel grow, but also it helps other people who may be interested in this information be able to receive it. Thank you and goodbye.